If you have investments located overseas, you may be thinking, should you relocate them to New Zealand or leave them where they are? Today in this video, we'll look at the pros and cons of overseas investments and when it might make sense to relocate these to New Zealand. Hi, I'm Jim Smith, Senior Financial Planner here at Pacific Wealth. We specialise in helping new migrants and returning Kiwis navigate the intricacies of cross-border financial planning to help you make the most of your new life in New Zealand. Today in this video, we'll look at the pros and cons of overseas investments and when it might make sense to relocate these to New Zealand. If you've lived overseas, you may have accumulated investments in those countries, such as shares, funds or property. If you're planning on living in New Zealand longer term, the question is, do you repatriate those investments to New Zealand or keep them offshore? There's no one-size-fits-all answer, but the first thing to assess is whether or not you are temporarily exempt from New Zealand tax on your investments by virtue of being a transitional tax resident. The New Zealand Transitional Tax Residency rules can exempt those who qualify from paying tax in New Zealand on foreign source passive income for the first 4 years of becoming tax resident. To be considered transitional tax resident, you must not have been a New Zealand tax resident at any time in the past 10 years, so you may need to look back at previous visits and see if any of these triggered tax residency. Not qualify for the transitional tax residency before, so you can claim this only once. If you meet the criteria, then you automatically qualify. It is not something you need to apply for. Whilst you're a transitional tax resident, you'll be temporarily exempt from New Zealand tax on certain sources of passive income. This includes rental income, such as from an overseas property, foreign dividends from shares and interest from foreign bank accounts, investments that would normally fall under New Zealand's Foreign Investment Fund or FIF rules, withdrawals from foreign superannuation schemes, income from foreign trusts, offshore business income that is not related to the performance of services. Note though that it's only foreign source passive income that is exempt. If you have earned income from wages or employment in New Zealand or overseas, then this is not considered passive, and it's likely that this income will be subject to tax in New Zealand. Whilst you're in the transitional tax residency period, there's often no strong incentive to relocate your investments to New Zealand, and in which case you may prefer to leave your investments offshore. But once the transitional period has ended, and assuming you remain a New Zealand tax resident, you'll be liable to tax on your worldwide income, including offshore investments and property. Offshore funds or shares are then likely to be taxed under the New Zealand Foreign Investment Fund regime. This regime applies to most international share portfolios, exchange-traded funds or ETFs, and managed funds valued over 50,000 New Zealand dollars. The fifth tax can be a little bit quirky, so it can help to simplify your tax reporting if your investment assets are held on a New Zealand domiciled investment platform, so the tax reports can be easily calculated. This could also help to reduce any tax leakage, as there can be overseas taxes or deductions that can be difficult to reclaim or offset against your New Zealand tax liabilities. Moving assets and consolidating your investment accounts may also help make your financial affairs simpler to manage and easier for you to implement a coordinated investment strategy going forward. There are a number of different investment platforms in New Zealand that offer a secure way to hold and manage investments. These offer a very wide range of investment options, including directly held shares on many of the world's stock exchanges, exchange-traded funds, and New Zealand domiciled funds such as portfolio investment entities, which can be tax efficient for certain types of investors. In addition, there can be advantages in holding New Zealand investments such as New Zealand shares and bonds, which you can access via the New Zealand-based custodian. Often the best time to start relocating assets to New Zealand is in the last year of the transitional tax residency period, so that you have sufficient time to make a plan and implement any changes. When moving funds or assets, you would need to carefully consider the best way to do this to avoid any unnecessary costs with buying and selling, capital gains tax implications for US citizens, and the risk of being out of market whilst your money is temporarily held in cash. Certain listed investments can be re-registered to a New Zealand investment platform, which can avoid triggering any sales, but for many others, a sale and buy may be the only option. But if selling is unavoidable, then this can still be worth doing in many circumstances and help to simplify your affairs and tax reporting going forward. At Pacific Wealth, we've helped many returning Kiwis and expats structure their investments in a way that's aligned to their objectives and the New Zealand tax system. If you've built wealth overseas and are wondering what to do with it, let's have a conversation. We can help you determine when and how to repatriate your investments and create an investment strategy that works for you. If you are interested to learn more about financial and retirement planning issues that international migrants need to know when moving to New Zealand, we've also created other videos that you can explore on our YouTube channel. You can also visit our website www.pacificwealth.co.nz, which has other information and articles, and where you can book a free initial consultation. Thank you for watching, and if you found the content helpful, please drop us a like, comment and consider subscribing.